So for the lecture today, we have a relatively short lecture. In the first part, we will talk about the different justification for investing overseas. In the second part, we'll talk about the effect of exchange rate changes on the investment returns, as well as some of the practical implications of investing overseas. Okay. So this graph shows you the relevance of foreign investments for US investors over time. And what we see here is over time from the 1980s to 2016, there have been an increase in investing overseas for US investors. Okay, so before in the 1980s, there were not much investment overseas by US investors. But by the end of 2015, I think this is 2015, by the end of 2015, the proportion of foreign investment for a typical US investor is about 30%, right? So this is a big proportion in the overall portfolio. So in terms of going to invest overseas, now one of the reasons why investment overseas have increased over time is because of technology, right? So in the 1980s, as you can imagine, it is quite hard to go overseas, both in terms of transaction costs as well as information production, right? So it used to be not very easy to acquire information before the internet, but after the internet and after some technology innovations, it is relatively easier for us now to invest overseas. Okay. So, for example, as a retail investor in Australia, if you have an account with CommSec, and if you want to invest overseas, you just have to fill in a certain form to declare taxes. Okay, and then you can then invest overseas. Okay, so it's not too hard in the sense. Okay, so what is the reason for investment overseas? Okay, for a portfolio manager, why is it important to also consider international stocks? So one of the reasons is because securities stock returns, for example, are much less correlated across different countries than within a country. Okay, so if you are an Australian investor and if you invest in a US stock, then the diversification benefit of that stock for your portfolio could be much more than an Australian stock. Okay. So one reason for why this is the case is because when you invest in a different country, you're exposed to a different economic, political, institutional, and even psychological factors that affect the security returns in that country. Okay, so as a result, because of the different in the fundamentals in two countries, when you invest into different countries, you might get a lower correlation, right? In addition, business cycles can also be different in different countries, so that in one country, if you experience a recession in Australia, then in another country, you might not experience the same thing. Okay, so that will help offset the losses that you would make in your Australian portfolio. So empirically, we can see that if we look at the past correlations between the stocks in the same country versus the stocks in different countries, we can see that within the same country, the correlation between stock returns tend to be higher relative to when we invest overseas. Okay, so here with the numbers in the circles, so these numbers tell you the pairwise correlation of individual stock returns within the country in question. Okay, so for example, on the top figure, I've got the stock correlations in Australia. Okay, so we're looking at the average correlations of all Australian stocks. Now, if we compare the pairwise correlation between Australian stocks and Australian stocks with other stocks in different other countries, we will see that the correlation between Australian stocks tend to be higher relative to the correlation between Australian stocks and another country. Okay. So with a lower correlation, when you combine your stock portfolio with a stock with a lower correlation, you will get more diversification. Okay. So this table therefore justifies the reason for you to invest overseas. Okay. So we can observe that the same thing happens for other countries as well. For example, with France, the pairwise correlation in France is about 57.6, but the correlation between French stocks and other country stocks is a little bit lower. Okay. So given that the correlation between the stock in our domestic economy and the stock in a foreign country is lower, if we combine these stocks, we will get a lower systematic risk, right? So if we remember this graph from our portfolio investment analysis, this graph shows you the relationship between the portfolio total risk and the number of stocks in the portfolio, right? And this graph basically tells you the benefit of diversification. So remember this from some other subjects, investment subjects. This is risk. Just going to write standard deviation for risk. So the traditional theory says that as you increase the number of stocks held in the portfolio, when the number of stocks increase, the amount of unsystematic risk will decrease, right? Eventually, when you hold a large enough portfolio, the only risk in your portfolio will be systematic risk, which is the risk that you can't diversify away, right? So as you increase the number of stocks here, your unsystematic risk becomes smaller and smaller, and eventually you can diversify away all of the unsystematic risk. Okay. Okay. So what this graph tells you is that when you combine two portfolio of stocks in two different countries, suppose that we're looking at Switzerland and the US. Now, if I just invest in Switzerland, then this is my diversification benefit, right? So if I invest in Switzerland and if I diversify my portfolio using Swiss stocks, then the amount of risk that I will bear in our portfolio is about 44%. Okay, so the systematic risk for the Swiss market is about 44%. Alternatively, I could be investing in just US stocks, okay? In which case, I'm looking at the blue line over here. So in the second case, when I just invest in US stocks, and if I diversify my US portfolio, my systematic risk will be 27%, okay? Now, the benefit of international diversification is that if I combine the stocks in these two markets, if I combine my Swiss portfolio and my US portfolio, I could get even lower systematic risk, okay? So in the orange line, I've got an international portfolio with the US and Swiss stocks, okay? So when this is the case, as you can see, the international, the systematic risk of the international stock portfolio becomes only 12%, okay? So when fully diversified, an international stock portfolio could have just half of the risk of a domestic portfolio, okay? So the reason why you can achieve a lower systematic risk for an international stock portfolio is because the correlation between two different country stocks is lower than the within country stock correlation. Okay, so as the correlation coefficient is lower, your diversification benefit is even larger. Okay. So on this note, let's look at the time series of the correlation in international stock markets over time. Now, from the 1980s to 2015, what we see is that we see an overall increasing trend in the correlation amongst international stocks, right? So it used to be, the correlation used to be a little bit lower, but these days it's become a little bit higher, okay? So why is that the case? What do we think is the reason? So one of the reasons why the correlation in the international stock markets has increased over time is because in the recent years, we've got international financial institutions like mutual funds or hedge funds holding international portfolios, okay? So as a result, these stocks in the international market now have an additional source of commonality, okay? So as you have the same common owner holding the same um, portfolio of stocks, the correlation between the stocks in the portfolio will increase, okay? Because when there is a shock to the same fund, to the same mutual fund, to the same financial institution, it's going to trigger sale of the same stocks of all the stocks in the portfolio, okay? So as you have a common owner across different stocks, it will increase the correlation of the stocks, okay? So the implication of a higher correlation in the international stock market also means that diversification benefits has decreased over time, okay? Which means for now, if you want to achieve the same diversification benefit as before, you are going to have to hold more stocks than before, okay? Okay. So in terms of optimal international portfolio selection, in principle, you want to combine stocks that have lower correlations, okay? So if you want to achieve higher diversification, you need to combine stocks with lower correlation, okay? For example, if I have a choice between a US stock portfolio combined with a Canadian stock portfolio, where the two correlation the correlation of the two portfolios is 77%. And another option where if I combine the US stock portfolio and the Japanese stocks, I will get a 38% of correlation, okay? So in this case, for a US investor with a US portfolio, it makes more sense for them to diversify by investing in the Japanese stocks, okay, relative to Canadian stocks, because they will get a higher diversification from the Japanese market, okay? Okay. So this exhibit 15.4 in your textbook illustrates the correlation coefficients between major economies in the world. It also shows you there's some statistics of the portfolio returns and risk for these different countries, okay? So a few points to note. So in the first four columns, we've got the correlation coefficients between Canada, France, Germany, Japan, and the UK with the United States, okay? So what do we observe here? We observe that for countries that are close together, so say if they are from the same geometric area, like the US and Canada, their stocks tend to have a higher correlation, okay? So for example, between the US and Canada, it's 72%. But if we compare the US stocks and stocks in these countries, so these are European countries, and this is Japan, and this is the UK, right? So the correlation between United States stocks and these different countries are lower than the correlation between US stocks and Canadian stocks, okay? Similarly for Germany, so if we look at the correlation between Germany and France, they are in the European Union, right? So their correlation is quite high. But if we compare Germany with Japan, for example, it's only 32%, okay? So geometric factors also play a role in determining how much your stocks are correlated with other countries, okay? So the implication here is if you want to diversify, maybe you can choose a stock in a different area relative to your own country, okay? So one more thing to note in this table is that in the last column, you've got the beta coefficient between your domestic stock market and the world stock market, okay? So this coefficient tells you how much sensitive your domestic market is to the world market. So for example, with Canada, they've got a perfect correlation with the world market. That means when the world stock market improved by 1%, their stock also improved by 1%, okay? So these betas are higher than 1. That means this country has a higher sensitivity to the world stock market, whereas these countries have lower sensitivity, right? So they don't tend to volatile that much. Okay. So in terms of selecting the optimal international portfolio, now the same principle would apply. If we remember from our portfolio investment subject, the principle for choosing an optimal portfolio, investment portfolio is the Markowitz portfolio theory, right? So the theory says that given a set of assets, there exists an efficient set of portfolio with the smallest risk at any given level of return, or the highest level of return given any level of risk, okay? So what it means is that given the choices between different individual countries, suppose you can observe all the different markets in the world and you can plot them on the graph. You can always compute an efficient frontier. So on this frontier, any portfolio, any combination of countries on this frontier will be the most efficient portfolio in the sense that they've got the lowest level of risk given any level of return, or they have the highest level of return given any level of risk, okay? So in the Markowitz portfolio theory, in that theory, we did not have any risk-free asset, okay? So all of the assets here on this frontier are risky assets, okay? Now, when we expand the Markowitz portfolio theory to include a risk-free asset, so if you think about government bonds, for example, that is a risk-free asset. So when we expand this theory to include a risk-free asset, and if we allow people to borrow and lend based on their risk appetite, then we get an efficient capital market line, okay? So this is called a capital market line. So in the presence of a risk-free asset, we will have an efficient combination of, efficient portfolio along this capital market line, okay? So any point on this capital market line is an efficient portfolio in the sense that it will maximize the portfolio expected return given any level of risk, okay? So it's outside of the scope of this subject, but if you want to find the weightings of the of the optimal portfolio, you can maximize the Sharpe ratio of the portfolio. Okay, so that is the principle of portfolio selection. Now, one thing to note is that this point here, where the capital market line meets the efficient frontier, this is what we call an optimal market portfolio. Okay, so this market portfolio includes all of the risky assets in the portfolio available to us, and by definition, therefore, this is a market portfolio. Okay, because it includes all of the asset available to us. Okay. So as an example, so in the textbook, you've got an example where the Sharpe ratio is maximized. And at that point, we can work out the weights for each of the assets, for each of the countries in our portfolio. Okay. So for this particular example, this is the optimal investment portfolio. Okay. So for this portfolio, we've got a 20% of our portfolio in the Australian market, about 8% in the Hong Kong market, about 16% in the Sweden market, and about 23% in the Switzerland market. Okay. Finally, we have about 31% of our portfolio in the US market. Now, the risk-free rate for optimization in this example is about 50.5%. Okay. So to evaluate the performance of a certain portfolio, people use the Sharpe ratio. So what a Sharpe ratio measures is that it measures the amount of excess return given any level of risk. Okay. So the Sharpe ratio is given by the difference between the expected return on the portfolio. So R bar I, RI bar, is the expected return on portfolio I. RF is the risk-free rate. So this term here is what we call a risk, an excess return. Okay. So this is how much your portfolio outperforms the risk-free rate. We then scale it by the measure of risk of the portfolio. So in this case, we measure risk using the standard deviation. Okay. So by definition, the Sharpe ratio tells you the risk-adjusted return of the portfolio. Okay. So to measure the outperformance of an international portfolio relative to a domestic portfolio, we take the difference between the Sharpe ratio of the international portfolio and the domestic portfolio. Okay. So if this difference is positive, that means that the international portfolio outperforms the domestic portfolio. Okay. Besides, we can also measure the extra return of the investment of the international investment portfolio, adjusting for the domestic equivalent risk level. Okay. So if we times the change in the Sharpe ratio with the standard deviation of the domestic portfolio, we will get the excess return of the international market measured at the domestic level of risk. Okay. So to illustrate, suppose if you just invest in a domestic portfolio, in this case, this is your mean return and this is your standard deviation. Okay. So our domestic portfolio yields about 1.11%, and the standard deviation is 4.25. Okay. In contrast, the international portfolio yields a little bit higher return, so 1.4, but the standard deviation is also higher. Okay. So the key question here is, how did you know which portfolio is better? Okay, so we can't just compare the mean return of the two portfolio because obviously they've got different levels of risk. Okay, so a fairer measure, a fairer comparison for return is to use the Sharpe ratio, where you adjust the return with the portfolio's risk. Okay. So for a domestic investor, the international portfolio has more risk and more return. But if we compute the Sharpe ratio, we will see that the Sharpe ratio for the international portfolio is greater than the Sharpe ratio of the domestic portfolio. Okay. So if that is the case, then we can say that the international portfolio is more efficient in the sense that it gives us more return given the same level of risk. Okay. All right. So we have looked at how to measure or how to compare the investment returns of different types of portfolios. So we mentioned that one way to compare the performance of different portfolios is to use the Sharpe ratio, where we compare the return given the same level of risk. Okay. So in the next few slides, we will talk about how exchange rates fluctuations might affect the return of our portfolio, okay, of our international portfolio. So when we invest overseas, of course, at the start, we have to convert our currencies into the foreign currency. Then we acquire the foreign asset. And when we want to exit the investment, we are going to convert the foreign currency back into the domestic currency, right? So at both stages, we are exposed to a high level of exchange rate risk. So given that when we invest overseas, given the differences in the currencies, the realized domestic currency return for a citizen should be given by this formula over here. Okay, so for example, the realized dollar return for a US resident should be given by this equation here. So where does this come from? Now let me explain this equation first. So RI is the local currency return in in country I. E is the change in the exchange rate between the local currency and the dollar. So where does this equation come from? Now, the stock returns is simply just a measure of change, right? So by definition, a return is the difference between the price that we sell the investment at minus the price that we buy the investment at, divided by the price that we buy. Okay, so if I want to measure the investment return of a certain asset, this is how I measure return. Okay, so here is the price that I exit the investment at, and this is the price that I invest. So this is the amount of investment I make at the start, scaled by the initial investment, right? So the investment return in my domestic currency, suppose I'm a US citizen, will be given by this ratio here. P0 US. Okay. So if I want to measure the change in the price of my investment in the USD, this is how it looks like, right? So in the bottom, I've got the investment return, the initial investment in USD, and on the top, I've got the value of my investment at the time I exit the investment. Okay. Now, because I invest overseas, I'm going to have to convert it into the overseas currency. Okay. So here it will be equal to P1. Let's say I invest in the UK, so it will be P1 pound divided by P0 pound times the exchange rate. Okay. Does that make sense? So here on the left hand side, I've got the USD value of my investment, and on the right hand side, I've got the foreign value of the investment in the pounds, converted into the USD using S1 and S0. Okay. So if I rearrange the equation, if I minus 1 by both sides, on both sides, this is what I'm going to get. I'm going to have to erase. So if I minus 1 on both sides, then I can write my equation as pounds minus P0 pound divided by P0. Okay. So here I'm going to write 1 plus, because I minus 1 here, so I'm going to just plus 1 here. Similarly, I just minus 1 before, so I'm going to plus 1 back here. Okay. Times S1 minus S0 divided by S0 plus 1. Okay. So here, once again, I just minus 1 here, so I'm just going to plus 1 in here. So this ratio here is the return on my US investment, isn't it? So this is the difference between the price I sell the investment at and the price I invest initially. So if I call this RIS USD, sorry, I will get the 1 plus RIUSD. Now on the right hand side, this will be the investment in the foreign currency. So this would be RI pound, right? So this will be RI pound plus 1 times, so this is the change in the exchange rate, right? So this will be times E plus 1, where E is the change in the exchange rate. Okay. So this is where your equation here comes from. Okay. So if I expand this equation, I can write this as Ri plus E plus Ri times E. Okay. Where Ri is the so in our previous example, this will be the pounds, and E is the exchange rate, okay? The change in the exchange rates. So as an example, if you have a US citizen investing in the UK, now suppose the return in the pounds is 15%. So this is the investment return in the UK. and this is 15%, right? Suppose also that the change in the exchange rate is minus 5%, okay? So here the pound depreciates by 5%. So my E here is a minus 5, okay? Now, in this case, if I put this information into the equation that I saw before, I can work out that the dollar return for this investment should be 9.25, okay? So 1 plus investment in the US, 1 plus return in the US, sorry, equal to 1 plus return in the UK times 1 plus the exchange rate change, okay? So here it will be 1.15 plus 1 minus 5%, so that will be 0.95. Okay. Sorry, minus 1 as well. No, not yet. So if I rearrange where RI USD is on the left, oopsie, this is times, not plus. Then I will find that it will be equal to 1.15 times 0.95 minus 1, okay? So overall, the return in the dollar is going to be 9.25%, okay, for this investment. So this should read 0.095925, okay. Okay. So the example illustrates to us that the final return, the local currency return of the of an overseas investment, not only depend on the foreign investment, but also on the exchange rate risk. Okay. So as a result, when you compute the variance of the return for a foreign investment, it will be a combination of the variance of the foreign asset itself, the variance of the exchange rate, the covariance between the two, and also a cross product between the exchange rate and the foreign asset. Okay. So, like I said before, the variance of your asset return is going to depend on the volatility of the exchange rate itself, on the covariance between the foreign market returns. So this is the foreign asset. Okay. Just to distinguish between our local currency and the foreign market. Also the contribution of the cross product term. So as an example, now in this table, we decompose the variance of our asset in our domestic currency into different components, okay? So what we have here is we have two asset classes. We've got bonds and stocks, and we've got different countries here, okay? So in each of the rows, we are looking at the contributions of each of these components to the overall portfolio variance for individual assets, individual countries, okay? Now, the variance that are related to exchange rate risk are the ones here, okay? So this one is the variance of the foreign asset itself, and these are the variance related to exchange rate risk. Okay. So if you compare the two asset classes, bonds and stocks, you can see that overall for bonds, the return on a bond investment tend to depend a lot on exchange rate risk variance. Okay. In contrast with stocks, the contribution of exchange rate risk on the overall variance is not as much. Okay. So the implication here is that when you want to invest in international bonds, you need to worry a lot about exchange rate risk. Okay. In contrast with stock investment, it is not a big issue. For stock investment, most of the variance comes from the variance of the foreign stocks itself. Okay. Okay. So like we mentioned before, with the bond portfolio, a lot of the risk of bond portfolios comes from exchange rate risk variation, whereas with stocks, it's from the stock in the foreign market itself. Okay. So the use of the euro, therefore, is likely to reduce the risk of the Eurozone bond markets because it increases it reduces the currency risk of the euro countries. Okay. So in the final part of the lecture, we're going to talk about different types or different products that allow an investor to diversify their portfolio internationally. Okay. So one way to diversify your international portfolio is you can buy an international mutual fund. So a mutual fund is an investment fund that invests in a certain stock. So for example, if you have a mutual fund that invests internationally, then in their portfolio, they will hold international assets. Okay. So with investing, if you compare between buying international stocks individually and investing in just a mutual funds, then obviously with the mutual fund, the transaction costs are lower. Also, sometimes in some countries, you cannot invest directly into the country stock. So using mutual funds can help you get around that problem. Mutual funds are also managed by professionals. So you can get access to professional investment management services as well. Okay. So in terms of the performance of international mutual funds, in this table, we've got, we compare the returns of different funds with the US market index, okay? So on the first column, I've got the average investment return. On the second column, I've got the standard deviation of the investment fund. Okay, so these are the first two moments of the distribution. Here I've got the beta coefficient. Here I've got the R square. And finally, I've got the Sharpe ratio. Okay, so as we mentioned before, we want to use the Sharpe ratio to compare performance because this is risk-adjusted returns. Okay. So overall, it looks like these portfolios, these mutual funds tend to have a higher Sharpe ratio relative to the S&P 500 in the US. Okay, so the implication here is that the international portfolios tend to outperform the US market index on a risk-adjusted return basis. Okay. This is not too important. So this is just to reiterate what we talked about before. So here I've got the US capital market line, and here I've got a world capital market line. Okay. So when you have a higher slope, so the slope for the world capital market line is higher, that means you've got more return given the same level of risk. Okay. So for example, if I compare these two portfolios with the same risk, one US and one world, I can see that the investment return for this portfolio is higher than the US investment return, illustrating that the world index is more efficient than the US index. Okay. So the second method to diversify your portfolio internationally is you can also buy country funds. So country funds are again one type of investment funds where the fund itself specializes in just one particular country. Okay. So this allows investors to speculate in one single country with minimum costs. So for example, if I want to buy a US index, I can buy a country fund that specializes in just the US market. By doing so, I can also construct my own international portfolio rather than relying on an international mutual funds. In addition to that, I can also access the markets that are otherwise more costly to do so, right? So in some emerging markets, it's very costly to invest because the exchange is not as developed, okay? So similar to before, empirical studies have shown that the country funds tend to do quite well relative to a portfolio where we just have US stocks, okay? So another way to diversify internationally is to buy American depository receipts. So what these financial securities do is that it's similar to a stock, to a cross-listed stock. So it is a stock on a foreign share, but it is denominated in the USD. Okay. And the bank is so the securities are deposited in a bank, and the bank will write the ATR to be traded on an exchange. Okay. So it's similar to a cross-listed share. The only difference is it goes through a bank. Okay. So to use the ADRs, it gives you a few advantages. Firstly, it is denominated in the USD, so you can take care of the exchange rate risk automatically. Finally, we can also use, not finally, but another way is to use exchange traded funds. So this is quite accessible for retail investors. So if you want to invest in the world market, you can use exchange traded fund issued by, say, Vanguard. So if you go to the stock market, if you go into your ComSec account and you type in exchange traded funds, you will see a list of exchange traded funds to choose from. Okay. So exchange traded funds are basically investment funds that are traded on an exchange like a stock. Okay. So when you buy a stock in an exchange traded fund, you get exposure to the portfolio of that exchange traded fund. Okay. So one of the popular world international exchange traded fund is the World Equity Benchmark Shares, or WEBs. So this is traded on the American Stock Exchange, and this is managed by Barclays. Okay. Another popular international global index is MSCI. So recently, this becomes a another popular world index for investors to choose from. Okay. Yeah, so there's not much to talk about here. Alternatively, you can also choose hedge funds. Now, the difference between hedge funds and an index fund or an exchange traded fund is that with hedge funds, this is privately pooled investment funds. And when you invest in a hedge fund, you are exposed to their own asset investment portfolio. Okay. So hedge funds by nature is a bit more active. So they are not passive investment funds. Okay. So hedge funds are aggressive. They tend to use leverage. They tend to use a lot of short positions and derivative contracts to achieve higher investment returns. Okay. Hedge funds also invest in a wide spectrum of securities, such as currencies, bonds and stocks, commodities, and real estate, so on and so forth. So the main purpose of the hedge fund is to beat the market. So they want to earn positive excess returns, regardless of the market conditions. Okay. So as we mentioned before, the risk related to hedge fund is quite high relative to a passive index fund. Okay. Because most of the time they will make a bet on the market direction, and if the hedge fund goes wrong, it can go bankrupt. Okay. So one of the famous examples of a hedge fund failure is the long-term capital management. So an interesting thing about this fund is that it was established by two Nobel laureate winners. So the people that write the option pricing model. So what happened was this fund was specialized in currencies, and they were betting a lot in the Russian market. Okay, so when the Russian economy went down, they had to default on their currency, and the hedge fund went down with that as well. Okay. Another risk associated with hedge fund is liquidity. So when you invest in the hedge fund, you need to contribute to the hedge fund at the start. And some hedge funds have a clause where there is a certain period where you cannot withdraw your fund. Okay, so there's no redemption within that lockup period. So in that period, there is a lot of liquidity risk because you cannot take your money back. Okay. Whereas with exchange traded funds, you can just sell off your exchange traded fund if you don't want to hold it anymore. Okay. Now, in terms of costs, hedge funds tend to be more expensive relative to more passive index funds. Management fee is normally 1 to 2% of asset value, and the performance fee is very high. Okay, so if you can beat the market, they charge you about 20 to 25% for performance fees. Okay, so as a result, because of the high trading costs, normally when we look at the data, the performance of hedge fund is not necessarily better relative to more passive funds. Okay, so one safe way to invest is therefore to just buy an index fund. If you want to take risk, then you also have the hedge fund to choose from. Okay. All right. So now one of the common features in international investment is that over time, empirical studies have found that there is an overrepresentation of domestic stocks in an international portfolio, and there is an underrepresentation of foreign stocks. Okay, so people coin this term the home bias, which means that investors tend to invest too much in domestic stocks and they tend to not invest enough in the foreign stocks. Okay, so why is that the case? Now, number one, domestic stocks could provide a superior inflation hedge. So in some countries, like developed countries, where the inflation rate is not too high, domestic equities have an advantage of having a lower inflation risk. Whereas for countries developing countries, sometimes inflation could be a bit of a risky factor. Okay. Also, for a domestic investor, the domestic market is more familiar to them. So you know the rules, you know the type of business, you know the fundamentals well. But to go overseas, it's a bit more uncertain. Okay, so you need to understand the legal restrictions, you understand the institutional factors in another country, so on and so forth. Also, taxes and transaction costs or information costs could be one of the other reasons for why investors don't go overseas too much. Okay. In addition to that, exchange rate risk could also be a factor. So if I invest in the US, for example, and the USD depreciates in the future, then I'm going to, when I convert the investment back into the Australian dollars, I might make a loss. Okay. So in terms of the extent to which investors underinvest in foreign countries, this table shows you how much. Okay. So in this table, I've got different countries in the first column. Now, in the second column, this is the average percentage of the world of international stocks in an average portfolio in each of the countries. And in the final column, I've got the proportion of the local economy. Sorry, I've got the proportion of local equities in the domestic mutual funds. Okay. So this second column tells me how much the economy, the local economy is in the world market. So for example, for Australia, it contributes 1.7% to the world's GDP, okay, to the world market value. In contrast, for a typical mutual fund in Australia, they invest 78% of their stocks in Australian stocks, okay? So this is a very high percentage relative to how much the Australian economy is in the world economy, okay? Similarly, for Brazil, they invest 100% in their own domestic stocks, okay? Which is a bit funny. So it seems like they only invest domestically, okay? Similarly, for Japan, the mutual funds in Japan overwhelmingly invest in Japanese stocks only, and so on and so forth, okay? So as you can see on this table, it seems that even for professionals like mutual funds, they tend to overweight the domestic stocks too much relative to international stocks, okay? So home bias is a real thing, and it affects all of the countries, okay? It's not just one feature in Australia or in the US, it's a feature across other countries as well. Okay. So that is the end of this topic. So we've got a relatively short topic for today. Now, in the next few minutes, I'm going to stay back. So if you have any questions about the exam or anything, you're welcome to ask me now. Otherwise, I will see you next week for the revision. Okay. Also, next week, we don't have any tutorial. We only have the revision lecture. Okay.